All right, let's switch over to the last one I want to talk about today. This is your Preferred and Income Securities ETF, PFLD. And I know a lot of people in the community either already own this ETF or definitely heard about it, but preferred stocks are usually one of the last things people start investing in. So can you kind of tell us about this fund, maybe obviously what they do, but also who it's maybe geared towards?
Yeah, 100%. Honestly, I'll start with who it's geared towards first because I
Sure.
think it's definitely the main reason for why we've seen demand, and that's the potential for tax efficient income. So, and I think this honestly gets into a little bit of a deeper discussion in terms of what is a preferred stock to begin with. Preferred stocks are hybrid securities.
Mm-hmm.
They sit in the middle of the capital stack, lower than bonds, higher than common stock. So because of that, they also tend to share some similar characteristics to each of those as well. Like a bond, they're sensitive to interest rates. They don't have voting rights. But like a common stock, and this is kind of where I'm going with this, is that they pay a dividend. They don't pay a coupon. A preferred stock pays a dividend, and that dividend, depending if it meets certain holding period requirements and the other requirements as well, can potentially be receive a characterization as a qualified dividend. So
Mm-hmm.
that's being able to achieve a higher level of tax efficient yield within a fixed income portfolio is something that clients are highly sensitive to, given the fact that bonds are typically taxed at the highest ordinary income rate for an investor. So that's typically the reason why investors look to preferred stocks overall. PFLD has typically seen a large majority of its dividends historically get that QDI tax characterization as a commonality within the preferred stock ETF space. That's really the like a good reason as to why we've seen a lot of demand for this strategy in particular. It's also one of the higher yielders within the space as well. But just to kind of go into how we kind of thought about this strategy is that from an index based standpoint, there was no one else enacting the screens that I'm about to go through in terms of the portfolio from an index based standpoint. So we're starting off with a broad universe of the U.S. exchange listed preferred stock landscape. So U.S. dollar denominated preferreds, and we're enacting two screens. One, I kind of alluded to it, and it's in the name too. It's the duration screen. Any preferred stock with a duration over 5 years, an option adjusted duration over 5 years, is going to be removed.
Mm-hmm.
On top of that, any preferred stock that is trading above 5% of its face value is also removed from the portfolio as well. So the reason for that is even though it's a low duration strategy, it is still evergreen from the standpoint of in a rising rate environment or period of high interest rate volatility, the strategy, that duration screen is going to be able to help mitigate a level of the interest rate risk that is significantly present within the preferred stock market. Whereas that call screen's also really interesting because it can potentially be something of use within a declining interest rate environment. So what do I mean by that? So preferred stocks are typically, and like a bond, can have options embedded in their securities. Preferred stocks are largely have a call option embedded within them.
Mm-hmm.
Typically within 5 to 10 years gives the issuer the right to call it back at par value.
Yep.
Naturally, if rates are declining and they can, buy back that preferred and then issue a new one at a lower interest rate, they will definitely do that in order to, help them manage their balance sheets. By having that screen, that call risk screen, we're able to limit a level of that and the reinvestment risk that comes with that as well. So, being able to have those two screens kind of counterbalance one another for both types of interest rate environments, we thought was really key when launching the strategy. And the overall, just to give a little bit, and this is similar within some other preferred stock strategies as well. But PFLD typically and this is the preferred stock landscape in general, typically leans towards big banks,
Mm-hmm.
utilities companies. These are highly regulated industries
Yep.
that typically have to meet certain capital requirements or capital ratios as per the regulations that they have to abide to. So those are typically the sectors that PFLD is exposed to. There's some real estate exposure as well. Some mortgage REITs can
Mm-hmm.
be found within the portfolio, and the overall credit quality of the portfolio will definitely differ upon a rebalance, but a majority of it is within that triple B range. So Definitely a strategy that we've seen investors utilize, and maybe it can be in an alternative sleeve, because again, preferreds are pretty
Mhm.
different, from fixed income and equity, in terms of they're similar, but when you combine all their differentiations together, they are a little different than each of those types of securities. So we've seen investors use them in that scope, but also, and this is probably the primary way we've seen them used, but also as a complement within like a high yield credit sleeve in a portfolio as well, in order to increase tax efficient income. So yeah, PFLD and is definitely something that we're really intrigued by right now, just because high interest rate volatility, given some of the concerns about, again, tariffs and the
Mhm.
potential for elevated inflation and elevated interest rates, and the strategy overall has grown. It's our flagship fund. It's grown to well over 500 million in assets as of this discussion, and a lot of it has to do with the fact that it's offering a high distribution rate, while also being able to, again, get some of that tax efficiency as well.
Yeah, that's great. Just for everyone's awareness, the yield is around 6.69 right now, and expense ratio is 0.46%. And some of the top holdings, like you said, are mostly banks. We have Goldman Sachs, JP Morgan Chase, Duke Energy, US Bank Corp, and Athene Holdings are the top holdings as of right now. Obviously, subject to change, but it just gives you a sense on the quality of the names that these preferred stocks are from. The tax efficiency is definitely a big benefit, because a lot of these other ETFs out there, like the covered call side of the business, a lot of those are taxed at ordinary income rates. But to have a high yield in the high sixes and get a tax efficiency with a long-term capital gains tax rate is a huge benefit for those people. And it's not how much you make, it's how much you keep. And if you have to pay less taxes, you're going to keep more. I also like that it's a monthly distribution, so that was really helpful for those who are relying on the income right now.
Yeah, 100%. I couldn't have said it better myself. I mean, it's definitely, yeah. I mean, the tax efficiency is something that we get asked about the most in terms of the overall strategy. And then also, I mean, PFLD, and this is really what we find also really interesting about it, is that, look, it's an index-based strategy, but it also rebalances monthly as well. So even though it's passive, it's highly active. Like, the turnover can definitely be significant at some times, less significant during some other times, just depending on how the overall makeup of the initial universe is. So we do look at this as something that's like, look, it's passive, obviously by all accounts, but it is fairly active in terms of the portfolio management that's going on based on the index criteria that has been set before it. And then honestly, one last thing that I would add, because I think this is actually really important just for the
Mhm.
for the viewers to be aware of. I think 2023, we saw like that regional banking crisis occur,
Mhm.
and kind of saw the word contingent convertible within the space as well, kind of come up, and some of the concerns regarding that specific type of hybrid security structure come into the limelight, because PFLD concentrates on US dollar denominated preferreds and US domiciled preferreds. The strategy wouldn't be expected to own those types of securities, so mitigate some of that risk that investors were definitely showed concern of, from that specific structure that is typically found within the European side of the preferred and hybrid securities markets as well.
Okay, thanks for the additional information. Yeah, I mean, I think just generally, if someone's investing in preferred stocks, they're probably a lower risk type of client. So anything that we can do to mitigate those risks out there is probably a good thing for this client base.